Real estate investment presentation, capital gains exclusion. Get ready because we're raising the stakes with real estate. As we consider capital gains exclusions with relation to home sales, remember that we're talking about income tax, more specifically federal income tax. Federal income tax being something that can change as laws change in the future. Those changes could be beneficial or non-beneficial to us and our specific circumstances in the future. We need to take that uncertainty into consideration when we make long-term type of investments, such as investments in, say, real estate. Also note that the capital gains exclusions for the personal property or the personal residence are something that have been around in some way, shape, or form for a long time now. So it would be politically unpopular, you would think, for the law to just basically remove them at some point. But you can imagine changes in the law which could make it either more or less beneficial to people depending on, in essence, their circumstances. We're going to be referencing here Investopedia by Chad Landgagger. Note that Investopedia is a place you can go to look up investment-related terminology and continue your research from there. So let's get a general idea of what we're talking about with regards to capital gains tax on the home sale. So we're talking about the sale of the home at this point in time. So obviously, if you're thinking about investing in a home, then you're hoping that the value of the home will, of course, go up in value. And then at some point in time, you might sell the home. That point in time, when you sell the home, that's when you're most likely going to be subject to the income taxes in the form of capital gains taxes. So let's think about that a little bit more in depth here. Remember that in the United States, we in essence have an income tax. The income tax is going to be based on the income that is earned. Normally, we think of income as being like W-2 type of income for work that we have done and so on and so forth. But we can have other income sources such as the capital gains income. So when we own the property, then we're of course hoping that the property goes up in value over time. And you might then say, or you can think that, of course, we're generating, in essence, value or income, kind of passive income, if the property does go up in value over time. However, we haven't really realized what they call realized that income at that point because we haven't actually sold the property. So as you're holding on to the property and it goes up in value, you are, in essence, generating kind of like income. The value of the property is going up over time. But it's not realized income. And if the IRS was to tax you, if the government taxed you on that increase in value, it would be a problem because you don't even have the money of it increasing in value, right? It went up, but you didn't actually sell it. You couldn't really pay the taxes possibly at that point in time. Also, the fact that the property went up doesn't mean the property is not going to go back down next year, right? You don't really know what's going to happen. Therefore, there's problems with these capital gains until they're realized to actually charge them as, in essence, income. So when you do actually sell the property, then at some point you sell the property at some later point, then that's when we say they realize the gain in the property. So the gain in the property might have happened over the last 15 years, meaning you bought the property at, say, $100,000, you sell it at, say, $300,000, you have a $200,000 gain. That gain didn't happen in 1 year. It might have happened over 15 years or something like that. But that gain has now been realized at the point in time that you sold the property. So that's at the point in time where you could be subject to that income, which we try to call a different kind of income. We call it the capital gains income. And one reason we call it the capital gains income is because we're trying to separate it from those wages incomes due to that difference in the characteristics of it. Meaning we have this kind of different phenomenon happening where we're actually realizing income that may well have been accumulated over time in the form of the increase of the property, which we're now realizing at this one point in time when we sell the property. Now, with regards to a home, if we have this big capital gains that is going to result in a large tax, then that could cause problems for people that get kind of locked into a home, because if they sell the home and they have this big tax that they're going to take on the sale, then they're going to be less likely possibly to move around. That's one argument where you'd want to say, well, we're going to, reduce the capital gains. Other arguments would be that, the capital gains tax should basically be lower due to this fact that basically the gains could have accumulated over time. And the fact that we have a progressive tax system means that if I take 15 years of taxes or income that I have generated over 15 years and I just tax it in 1 year, that means it's going to kick me into a much higher tax bracket than I otherwise possibly would have been in if you had taxed me over 15 years, if I got the gain over 15 years. So these are arguments as to why the capital gains tax, in essence, should be lower than basically the income tax. So now we got these different rates oftentimes that will be applied to capital gains tax. And then you've got this idea of an exemption for individuals if it's a personal residence, which we're going to be going into now, which could be a huge benefit to people that are selling the property. So that's the general idea. So now you're talking about the tail end of the investment, the front end being you buy the property, you're investing in the property, hoping that it goes up in value, and then at the end, when you sell the property, whether you're planning on selling it in like 2 years or 5 years, or staying in it for the entire your life and then selling it at retirement or something like that, that's the point in time that these taxes kick in at that point. So that would be the idea. So did you know that your home is considered a capital asset subject to capital gains tax? If your home appreciates in value, you could be required to pay taxes on the profit. However, thanks to the Taxpayers Relief Act of 1997, most homeowners are exempt. So the idea then is going to be if it's your personal residence, you might be exempt from the taxes, which again could be huge because you could have a significant gain in property, especially if you've been living there for like 30 years or something like that, and the property values have gone up over time and you want to sell, then it could be a very good thing to have the exemption of the capital gains tax. So if you are single, you will pay no capital gains tax on the first $250,000 of profits excess over cost basis. So when we think about excess over cost basis, remember if you sell the property and you're selling it for, there's a couple things that kind of muddy the water that people get a little confused on. If you have the property and you bought it for like $100,000, you might have the loan that's going to be on it that you're going to have to pay off, say $80,000 when you first bought it. And then after some portion of time, let's say the property goes up to $200,000. If it goes up, let's say it goes up to $300,000. If it goes up to $300,000, you still might have that mortgage on it as well. But we're really looking at the difference between the purchase price, the $100,000 and the $300,000 in that case, to think about the change or the increase in the value. So that difference, $200,000 in that case, could be the gains. Now, you could have many other factors that could adjust what they call the basis, the cost or basis, meaning the basis represents what you paid for it, including the amount that, in essence, you financed for it. And it could also include adjustments to the basis, like if you made improvements and things like that, substantially adding to the value of the property, adding, say, a room or put an add-on to it, and there's significant improvements and that kind of thing. So married couples enjoy a $500,000 exemption. So there are, however, some restrictions. So you can see this would be a significant, basically, exemption, because we're not really talking about if you sold the home for $300,000. We're not saying that otherwise, without the exemption, you would have income of $300,000. That's not what we have. We have income of the sales price minus what you paid for it way back whenever you paid for it. You might then get into questions, well, what if I inherited it and this and that? Then you got to get into the basis problem. What if I put improvements in on it? What if I did this? The basis calculation is often going to be a significant question. But the idea then being here, when you sell it, you're talking about the sales price minus the adjusted basis. That's what your gain is going to be. So if you bought it for $100,000, you sold it for $300,000, that's a significant gain of $200,000 in that case. And you've got an exemption, even if single, of $250,000, right? Which is huge. So that means that income that you have that you would normally have to include as capital gains, as income, but under another category instead of ordinary income, it's capital income, which could be subject to a lower weight, but still, you may not have to include that then, which could be a huge tax benefit. If you're married, it's doubled, right, to $500,000. So that doesn't mean that you sold the home for $500,000. That means that you actually have a gain of $500,000. So that would mean, you purchased the home for $500,000 and then you sold it for $1 million. You would have a gain of the $500,000, and this exemption is for the $500,000 if married. So again, huge, kind of exemption for the personal property. So how much is the capital gains tax on real estate? To be exempt, the home must be considered a primary residence based on Internal Revenue Service IRS rules. Now, you might be imagining, well, do I qualify, first of all, if it's a primary residence? Obviously, if you live in the home and it's your primary residence and so on, you could be fair, you know it's a primary residence. It's fairly straightforward. You can imagine types of scenarios of like, well, what if is there any way I can work this into my investment strategy or so on and so forth, and imagine scenarios where, you could retire by owning property and moving into the other property, making it your primary residence for the minimum amount of time in order to get the exemption and so on, and these types of scenarios. So in general, if it's your primary property, fairly straightforward. And then if you're being creative in your investment strategies, then you could say, well, how long would I have to be in there specifically to make, say, a rental property into like a primary residence? So these rules state that you must have occupied the residence for at least 2 out of the last 5 years. So that's one of the big rules that you have. Again, if it was a primary residence, you've lived in there for 15 years, then it's fairly straightforward. But 2 out of the last 5 years as your primary residence. Now, you can get into a lot of details in terms of, well, how do I prove it's my primary residence? What if the IRS questions me about it? And you can get out into the types of things that would make it, in essence, your primary residence. Do you get the mail there, right? Do you send in your tax return there? And these kind of things, right? So if you buy a home and a dramatic rise in value causes you to sell you later, you could be, in some cases, be required to pay those capital gains taxes if you weren't able to get the exemption. If you've owned your home for at least 2 years and meet the primary residence rules, you may owe tax on the profit if it exceeds the IRS thresholds, which again are significant, those IRS thresholds. So single persons can exclude up to $250,000 of the gain, and married persons filing a joint return can exclude up to $500,000 of the gain. So how much is capital gains tax on real estate? This rule even allows you to convert a rental property into a primary residence because the 2-year residency requirement does not need to be fulfilled in consecutive years. So now you might be saying, well, what if I own multiple residential properties and I'm renting one of them out and I'm living in the other one and so on, and I want to sell one of the properties? Could I get creative in order to get this exemption, right? Well, in order to meet this test, you'd have to live in them for that 2 out of the 5 years. So 2-year residency test. So suppose you purchase a new condo, for example, for $300,000. You live in it for the first year, rent the home for the next 3 years, and when the tenants move out, you move in for another year. So now you've got the 2 years that you've lived in it, but they weren't right next to each other. And, you're meeting basically the test, this particular test in that case. So after 5 years, you sell the condo for $450,000. No capital gains tax is due because the profit, $450,000 minus the $300,000, $150,000. So notice the difference in the profit we're talking about. We're not talking about the sales price, $450,000. They purchased it for $300,000. So the difference between the two would be the gain in that case. And that's less than the exclusion or the exemption, and therefore no capital gain. So consider an alternative ending in which home values in your area increase exponentially. So in this scenario, you sell the condo for $600,000. Capital gains tax is due on $50,000. So now you've got a very large capital gain, and it's over the exemption amount. So now you have the profit of $300,000 because you sold it for $600,000. And if you're single, remember the exemption was $250,000, a huge exemption. Now, if you're married, it might have been up to the $500,000, and you'd be okay in that case. But it's lower. The exemption is lower than the capital gain, and therefore you got that $50,000 subject to the tax. If your income falls between $80,000 and $441,550, your capital gains tax rate as a single person would be the 15%. Now, remember the capital gains tax. When we talk about capital gains versus income, remember it's an income tax that is taxable. So then hopefully you can get the exemption so you don't have to worry about the tax rates. But then if you do have to worry about the tax rates, you have different types of income. One is going to be ordinary income, which is subject to the normal ordinary income progressive tax structure, which goes up as your income goes up and so on, which can get fairly high as income goes up. And then you got the capital gains tax, which for some of the reasons we discussed earlier typically follows a different rule, which could change soon because they're talking, this is part of the law that people argue on all the time. What should the capital gains rates be and so on? But the capital gains are typically argued to be lower than the ordinary income, meaning they have a lesser of a progressive structure. They're typically going to be beneficial or lower than whatever your ordinary income rate is. In this case, 15%. So that means the other major restriction is that you can only benefit from this exemption once every 2 years. So again, if you're thinking about how to get creative with this strategy, you're saying, okay, I can live in the property for 2 out of 5 years, and I've got like 5 properties that I'm renting out. I'm going to go live in them every 2 years and then sell them or something. Then you also need to consider the fact that the other major restriction is that you can only benefit from this exemption once every 2 years. Therefore, if you have 2 homes and lived in both for at least 2 of the last 5 years, you won't be able to sell both of them for tax-free at that point, right? Because you can only take advantage given that rule. So the Taxpayers Relief Act of 1997 has been beneficial for homeowners because it has significantly changed the implications of home sales. So again, obviously this increases the people's ability to move, and you can see how people would kind of get locked into a home if they had to pay a lot of taxes in order to move. Obviously, they might be able to pay the tax if if someone got more than $500,000 of gain from selling the home, you would think that they could possibly pay the capital gains rates, which are lower than the ordinary income. But again, you could see how it would be more incentivizing to allow people to move around if they got the exemption and so on. That's the argument for it. So before the act, sellers had to roll the full value of a home sale into another home within 2 years to avoid paying capital gains. Now, if you remember this law, that was a while ago. It's been a while now. People still have this in their mind, though, which was the idea that in order to avoid the capital gains, you had to roll the money into another home of like equal or greater value, which you could see that had a lot of problems, because a lot of times when people are trying to sell their home, that's because they don't need that much home, right? They're trying to downsize on their home, and the tax code would then be incentivizing people only to get the gain if you bought a more expensive home, which seems counterintuitive. So they kind of changed that rule, which I think, that makes sense, because you don't really want to force, if you're retiring, you're trying to, anyways. This, however, is no longer the case, and the proceeds of the sale can be used in any way the seller sees fit. To me, I think that's a good idea just in general. The government should not be in the policy of telling people how to spend money, right? They should give the benefit, that's your choice, right? You get to do it. So anyways, they reduced it a little bit there. If you meet the eligibility requirements of the IRS, you'll be able to sell the home capital gains tax-free as stated above. However, there are exceptions to the eligibility requirements, which are outlined in the IRS website. So when is a home sale fully taxable? Not everyone can take advantage of the capital gains exclusion. Gains from a home sale are fully taxable when the home is not the seller's principal residence. So if it's not your principal residence, then you don't have that same kind of exclusion. The property was acquired through a 1031 exchange within 5 years. So a 1031 exchange is another kind of, could be beneficial in reducing the taxes. The argument being, well, I won't get into it now, but if you're subject to a 1031 exchange, that could complicate things as well. You can look at that in more detail. The seller is subject to expatriation taxes. The property was not owned and used as the seller's principal residence, so it wasn't the primary residence, which is one of the rules that most people are going to be looking into a lot. For at least 2 of the last 5 years prior to the sale, some exceptions may apply there. However, the seller sold another home within 2 years from the date of the sale and used the capital gains exclusion for that sale. So obviously you want to consider these in more depth. If you're looking at more complex types of situations, you can look at the IRS website, irs.gov, continue your research from there. You can also look into, and we're referencing here, Investopedia, Capital Gains Tax on Home Sales by Chad Landgagger, reviewed by Andy Smith on March 30th, 2021. This is, of course, something that's related to tax law, which can change over time. So as time passes, you might want to go to Investopedia and look and see if they've updated things there, and or continue your research to other resources such as the IRS website, irs.gov.